Hi everyone, welcome to episode 13, and the trigger for today's Learn on the Go presentation were these videos that I watched over the weekend. This first one was by Power Up Money, where Navda is interviewing Rajeev Thakkar, the CIO of PPFAS Asset Management. I also watched this one by Sonia Shenoy, where she's conversing with Neil Parikh, the CEO. And like any curious long-term investor, I also watched a recording of the unit holders meet during the weekend. Lots of good stuff here. Do watch it if you find the time. But as I was going through it, it did make me wonder how many of us actually make the time to understand a fund's philosophy, its objectives, the style of investing that the fund manager or the AMC employs when handling our hard earned money. Not many, I think. And that will be our quest for the day as I take you through certain examples of actual CIOs on how they operate, how they approach their investing. And I'll also take you through an exercise so that you can do this process entirely by yourself. Yeah, let's begin. Now, I did say a lot of people will be oblivious to who the fund manager is or what do they do exactly within a fund, etc. And something similar happened to me last week. This was with a friend who is running multiple SIPs. One of the SIPs he has is with Motilal Oswal Midcap Fund. It's a very popular fund. And I want to share with you how that conversation went. For this, I'll be using Power Up Money. Power Up Money is something that I use all the time for my mutual fund understanding. Thankfully, it's been made more like an advisory app rather than a transaction one. So it definitely helps me take better decisions. Cool. So, firstly, the fund has been ranked as number one for its category out of 29 different schemes. In terms of its performance, it's always been informed. I love the fact how Power Up Money gives us a very nice visual representation of which funds are in form, on track, off track, and out of form. So, green, orange, and red, which is very common. Uh, on a 6 monthly basis, it's either one or two. On a 1 year basis, it's generally been one. Even on a 2 year basis, it's right up there. So I think in terms of performance, it's absolutely top notch. Love the fact that over a 3 year rolling return analysis, it's 8.5% more than the category average. You can always dig deeper into this and see how it's been doing on a 1 year, 3 year, and a 5 year basis. So there's a wealth of data here. I'll request you to download the Power Up Money app. The link is there in the description. But now let's try and understand how much do we really know this particular fund, or at least how much does my friend know about this fund? Let's go further. So again, 1 out of 29, it's again broken down in terms of consistency, recency, volatility scores. And I'll look at the AUM. So it's currently 37,000 crores is the are the assets under management. But see, just a year back, or rather, in the last 1 year, it has gone up by 17,000 crores. Why is this important? Is because in the last 1 year, this particular scheme has actually delivered minus 3%, as we saw earlier. So it's in that same year that there's an additional 17,000 crores which has come into this particular fund, which can be a little surprising for people. The other surprise are the number of holdings. So notice this, it's 17 here. Let me tap on this. Let me also view all. Okay, so the first one is TRP. So trips are basically your it's cash equivalent. So 12% gets knocked off. So it's not 17, it's actually 16. And in terms of the different constituents, we have persistent systems, which is I think currently at a P ratio of 60 or somewhere on that. Coforge is definitely more than 50. Dixon Technologies, it used to be 100 and something. Now it's, I think, come down to 70. Eternal, which is Zomato, the P ratio is about 1500. So the point I want to put forward is that in terms of valuation of the constituents here, Motilal Oswal has a very distinctive style as compared to others. This will come through when we talk about some other AMCs. I'm not saying whether it's good or bad, but the point I want to drive here is that a lot of people don't understand most of these things. They look at either the performance or maybe the brand name, and they assume a lot of things, and this doesn't end up well for a lot of people. Okay, so let me continue a little more. Let's go right down. So we have fund managers here, four of them, and amongst these guys, it's Mr. Niket Shah who has spent the most time with this particular fund. So he is maybe he's primarily responsible for how well the Motilal Oswal Midcap Fund is doing. Again, I'm sure a lot of people don't know this, but Mr. Niket Shah is actually the CIO, the Chief Investment Officer of Motilal Oswal Asset Management Company. And in terms of experience, so I did some digging. And from 2008 to 2010, Mr. Shah was with Religare Capital Markets as an associate research analyst for midcaps. He then shifted to Edelweiss Securities, was there for 3 years as a research analyst, again midcaps. In 2014, he joined Motilal Oswal Securities as head of midcaps research before transitioning to the asset management side, ultimately becoming the CIO. So here's someone who has looked and relooked at hundreds of midcaps over the last 17 years. And now that you've discovered this piece of information, I'm sure some of you would have a lot more confidence in Motilal Oswal's midcap fund. We'll come to Mr. Shah and Motilal Oswal a little later in the video. But let's move on to a different fund house, the Nippon India Asset Management Company. It's a very old fund house, has been there for more than a couple of decades now. And the remarkable thing is, when you examine it over longer periods of time, so 10 years, 15 years of data, so basically long term, it's very likely that you would see a scheme from Nippon India featured there. For instance, this is the large cap category, and we have Nippon India Large Cap Fund right up there. Within the mid-cap category, it's sixth in the table, one of the many funds that have returned 19 point something. And even within small caps, we find that Nippon India is right on the top of that leaderboard as well. The CIO, the Chief Investment Officer of this AMC, is Sailesh Raj Bhan. Mr. Bhan joined the outfit in 2003 and has been managing these three funds for at least 19 years now, including the Nippon India Large Cap Fund, which has done extremely well. I won't be surprised if many of you haven't heard of Mr. Bhan. Not his fault, maybe he did not have a good publicist. But let me share with you something which will definitely make you sit up and notice him a lot more. All right, so I'm on Value Research Online. Let me click on Equity. So this will give me a list of all the equity funds out there. Quick check here. Okay, we don't want direct because direct started from January of 2013. Let's go for regular. And we're trying to gauge long-term funds here. Let's tap on returns. Let's look at long-term. Right, and let me do a descending order sort on 20-year funds. So the scheme that's right at the top is Nippon India Pharma Fund. Let me tap on this. And as expected, the fund manager is none other than Mr. Sailesh Raj Bhan. He's been handling it for more than 15 years now, since March of 2005. And over a 20-year period, this man has delivered 18.97, so 19% returns, which is an incredible number. Okay, now that I have your attention, let's look at his philosophy. And very simply, Mr. Bhan follows the GARP framework, growth at reasonable prices, or as some people nowadays call it, growth at sensible prices, or GASP. I've actually done quite a few videos on GARP. So if you go to my channel, just on the search bar, just type in GARP and you will be presented with a few videos. Yeah, so this was the first one I did, which is based on Peter Lynch's methodology. This was done at least a couple of years back. Then I did one on specifically on the GARP strategy. And this one here was a follow-up on that strategy, which was done quite recently, just a couple of months back. So have a look if you find some time. I won't be getting into specifics of these videos, but we will be going through specifics of Mr. Bhan's philosophy, and we'll try and capture the best parts of it so that we can adapt it to our own investing. Okay, so rule number one, according to Mr. Bhan, is never overpay for growth. In the sense that if you pay too much to buy a company, even if it's a world class business, the after effect of that single transaction is that your returns will be extremely delayed. In one of the interviews, Mr. Bhan explained this. By the way, whatever sources I am quoting here, you'll find a lot of this in the description of this video, so have a look at that. And he was referring more to consumer companies. And one of the examples which I can think of, this is not his example, this is my example, is actually Page Industries. Okay, let's look at valuations. Let's go down to the P ratio and see, currently it's at 56.9, but for a very long period of time, the P ratio was it's 80 in the year 2023 and 24. In 2022-21, it was more like 100 P ratio. And even if you go as back as August of 2018, you can see that the company was valued at 100 rupees for 1 rupee of profits. That's the definition of a P ratio. And let's say you had bought that stock during this period. So let's say August of 2018. So let's now check out the price. And in August of 2018, the price was some 34,000 rupees per share. And where is it right now? It's exactly 39,000 rupees. So 34,000 something to 39,000 is barely 15%. This is over a 7-year period, 7.5-year period, which means on a per year basis, you're looking at a mere 2%. Of course, that does not mean that the company did not do well. Let's go down to the P&L statement. Yeah, so August of 2018. So we can look at this. The net profits was 350 odd crores, and today it is more than double. It's 764 crores. So the profits have improved over these last 7 years. It has gone up by about 12-13% every year. Not just the profits, but even the sales have doubled from 2,500 to 5,000 crores, and so has the EPS from 311 rupees per share to 685 rupees. So all the metrics have gone up, but there's only one metric which has kind of stalled, which is the shareholders' returns, which has been very poor, just 2% of capital appreciation and a little bit of dividend also that came along with it. So this was an interesting example, and the reason I refer to this is because Mr. Bhan also seems to prefer a contrarian GARP approach, whereby he targets forgotten blue chip companies. These are high quality companies whose valuations have become sensible now following a period of correction or stagnation. This currently might include sectors like insurance, large banks, power utilities, maybe cement, some consumer stocks, essentially quality businesses that are out of favor or unloved by the marketplace. I wonder if Page Industries is one of those companies. After all, the P ratio has fallen dramatically from whatever 80, 90, it's gone down to just 57. In terms of return ratios, it's absolutely excellent. The ROC is 60%, the ROE is almost 50%. But yes, in terms of Hitch, I think the big problem is the sales growth, which has been only 8%. And the management themselves have been saying in their earnings calls that their first focus will be to get into double-digit growth. Now that I've mentioned the P ratio and growth in the same sentence, let's look at what Mr. Bhan has to say about the PEG ratio. So according to him, this number should not be more than 2 times based on the next 3 to 5 years of expected growth. As usual, what kind of growth has not been specified, but if you want to do it absolutely right, then please go with growth in EPS, that is growth in earnings per share. A second point, and what Mr. Bhan considers a defining feature of a disciplined investment strategy, is his belief that position sizing matters more than individual stock picking. So what is position sizing? Well, very simply, it's a tool that tells us exactly how much one should buy. Remember, not what to buy, but how much to buy, which essentially applies to both risk management and return generation. For example, let's say you're managing a portfolio of 10 lakh rupees. You find a stock, a mid-cap company, and experience has taught you that mid-caps do have this tendency of falling by 20, even 30% in a bad quarter. So instead of putting all your money in this one company, you arrive at a certain criteria on how you want to shape your portfolio. That is, the maximum loss you're comfortable taking on a single stock is 2% of your investment portfolio. So 2% of 10 lakhs is 20,000 rupees. This is the maximum permissible loss. And let's say the worst case scenario in case of mid caps is 25%. So essentially you want to size up your portfolio in such a way that even if a stock falls by 25%, the overall damage to your portfolio will not be more than 2%, which in this case is 20,000 rupees. Now, as a formula, position sizing is the amount of money you're willing to lose in the numerator divided by the worst case percentage loss in the denominator. So 20,000 divided by 25% comes to 80,000 rupees, and that's the amount of money you should be investing in that mid-cap stock. In essence, position sizing means that your biggest risks get only a small allocation of your portfolio. Steady ideas of a compounding nature will get bigger allocations, and your downside is mathematically capped. So if you've not used position sizing in the past, then do read up about it. Mr. Bhan is an absolute practitioner. He uses it quite strategically in terms of allocating money to exceptional but high value businesses, to momentum plays, towards contrarian bets as well. And of course, in terms of what percentage of assets should be allocated to steady but high quality businesses. I absolutely loved it when I read about this, when I researched about this, and I'll be sure to use it on my portfolio as well. And the third and final learning from Mr. Bhan that I would like to put forward today is his selling framework. From what I could gather, he divides his when to sell question into different categories. For instance, the core selling triggers based on GARP principles include A, any violations, that is, fundamental change to the investment thesis of the company or sector. Secondly, if the valuation becomes disproportionate, which is overpaying for growth kind of thing that we spoke of earlier. And thirdly, when investing starts shifting to speculation. An example of this is when a cyclical business experiences a rally and an investor is trying to capture the last 10 to 25% of the return, which normally doesn't end up well. Another example of this is when a business's valuation starts by incorporating the next 10, 15, even 20 years of growth, which makes it highly speculative and grossly impractical from an investing perspective. The other selling trigger is, of course, the role of sizing. We've already discussed this. This is not stock picking. This is more to do with our portfolios. And one should use sizing to increase exposure when the odds are with us and reduce it when the odds go against us. I know this entire section on Mr. Sailesh Raj Bhan was a bit long. Thoda patience chahiye in videos mein. But if you really look at the learnings, the GARP, the position sizing and the selling triggers, I think we have extracted enough information here so as to make us better investors. Okay, now let's look at India's most popular CIO, Mr. Rajeev Thakkar of PPFAS Asset Management. Like Mr. Bhan, Mr. Thakkar is also an old timer. He joined PPFAS Limited in the year 2001. He became a fund manager in 2003, was later the CEO. And when the mutual fund business was launched, he became the CIO and started managing its flagship scheme, the Parikh Long Term Equity Fund. We all know the scheme today as the Parikh Flexi Cap Fund. I have a bunch of investment here. It's given me 19.13% so far, and this is over 10 years. And see this, I made my first investment on the 23rd of November 2015. So what's the date today? Okay, so I have crossed 10 years now officially. And I remember when I first invested, the AUM was like 600 crores. And what is it today? Wow, it's 1,25,800 crores. And when I had invested, it was 600 crores. I don't have to say much about this fund, but between Mr. Thakkar, Mr. Ronak Onkar, and Mr. Raj Mehta, I think these guys are doing an incredible job and are responsible for the wealth building of many mutual fund investors in our country. Let's examine how they are running things and what we can learn from it. First up is the investment framework and Mr. Rajeev Thakkar's mannerism, his behavior, his presentation, all of it seems to be borrowed from the Warren Buffett school of investing. So, firstly, Mr. Thakkar subscribes to buying quality businesses. Quality here is three things. One, the return on invested capital should be reasonably high and growing and without excessive borrowing. Then there should be some long-term competitive advantage run by a competent management. And thirdly, the business should be capable of generating good positive cash flows. Okay, let's put this to the test. This is the fact sheet of October 2025. And for the FlexiCap fund, here are the top listings. As you can see here, a lot of it are very popular names and most of it is large caps. And what I did is I took all those 27 companies and populated them on Screener as a watch list. Okay, let me sort this first by market cap. And now let's go through each of these one by one. So firstly, per Mr. Thakkar, the ROC should be high and growing. So firstly, it has to be high. And if you just ignore the banking and NBFC companies, we can generally see that it's pretty decent. Like for example, Infosys 37, Maruti 21, ITC is 36, M&M is an exception, I think. HCL Technologies is 31, and then again, if you go down, you got Coal India. Yeah, so most of these companies have done well, not only in terms of the ROC, but they've also increased this number. The next point was on debt, and it said that the debt should not be excessive. And I think a good way of understanding this is basically the interest coverage ratio. So if it's more than 3, then things are under control. That's the basic principle here. And again, if you ignore the banking stocks or the NBFCs, you generally notice that the interest coverage ratio is above 3 for almost every company except for Bharti Airtel, which is almost there at 2.95. Mr. Thakkar's next criteria was long-term competitive advantages and a competent management. And I think a good proxy for that can be the operating profit margin. As you can see here, for almost every company, it's pretty high and dry. And this also seems to be the case with the operating cash flows, with all companies giving positive numbers. I've also added the free cash flow here as a bonus. And barring Mahindra and Mahindra, every other company has actually been adding to their cash flows. So this is one approach that you can definitely consider for identifying high quality businesses. The cash flows in the company, the operating profit margin, the interest coverage ratio, the return on capital employed, these are all very standard quality finding parameters. But that said, let's not forget the second filter, which is valuations. And it's a very important filter, which is probably why I see a lot of large cap companies within the scheme's constituents. As one can see here, all these companies are at a reasonable price earning multiple between 15 and 30, most of them. And it's only once we go down the ladder. So all these were kind of more than 100,000 crores of market cap. And only when we go down to, let's say, 50,000 crores and lower, that we start looking at companies which are a little more pricier in terms of their price earning multiple. Like MCX here is 75, you've got a 47, you've got a 71 with CDSL, 52, 49, etc. All right, let's continue. And the other significant aspect of the PPFAS style of investing is their emphasis on behavioral control and avoiding market noise. Mr. Parikh once summed up this philosophy in a single line: equanimity over genius leads to success, which has since become the cultural backbone of the fund house. In fact, every visitor who walks into their office is greeted by that very phrase, a quiet reminder of the temperament first approach that defines PPFAS. And what does this mean? Equanimity over genius? Well, the way I thought of it is that success relies more on staying calm and consistent and in avoiding getting carried away, especially during bull runs, or being too despondent when there is a bear phase in the market. We can see this in the way PPFAS works, with the fund now frequently holding high cash levels of around 22% as it waits for suitable opportunities while protecting investor capital when valuations seem a bit stretched. Please don't forget, cash in an investment scenario means treasury bills, money market instruments, etc., which is not zero. They actually give about 6.5% of returns. And there have actually been years when cash has been the best performing asset and has done a lot better than equities also. All right, let's round off our learnings from PPFAS. Just a few more. Don't chase hot sectors. Mr. Thakkar often says this. And as one can see here, there are no data centers, CDMO companies, water recycling, renewables, defense manufacturing, EV supply chain, semiconductors, precision farming, etc. He simply avoids it. Global investing, Mr. Thakkar does it more from the perspective of reducing country-specific risk, since global markets almost never move in tandem. Of course, since RBI restrictions, the percentage of global assets has been going down. What was 30% is now 12%. But the idea is good, and if you haven't thought of it, then you can definitely consider it for your own mutual fund portfolio. And lastly, in terms of future returns, he wants investors to be prepared for low double-digit returns. Yes, you heard that right. Low double-digit returns of around 10 to 12% going forward, rather than the fund's historical 19% return. His logic stems from simple math. That is, if India grows at around 6.5, maximum 7%, then adding an inflation of 3 to 4% would take us to equity returns of 10 to 12%. All right, so this was Mr. Rajeev Thakkar of PPFAS Asset Management. Let's do one more. Let's end with the person with whom we started this entire inquisition, which is Mr. Niket Shah, who is the CIO at Motilal Oswal Asset Management Company. As we saw earlier, he's an absolute specialist when it comes to mid-caps. And as for the fund house, you might have heard of this term QGLP, which is the process that the folks at Motilal Oswal follow. Very quickly, Q here stands for quality, which technically means investing in high quality businesses run by strong promoters and management. Key metrics to look out here include capital allocation, return ratios, and cash flows. G means growth, that is growth in earnings, which calls for seeking businesses with high growth potential. For example, if a company or sector is expected to exceed 20% in earnings growth, or if there is structural growth like what we saw with defense or with railways, renewables, EMS, quick commerce, etc. L stands for longevity, that is sustainability of the growth and also competitive advantages. This part is important, and what Motilal Oswal is looking for is structural stories that can offer a long-term runway, and it also means the intentional avoidance of cyclical businesses. And finally, there's P, or the price. As you might have expected, price involves ensuring the business is bought at the right price or at reasonable valuations, and as a process, it requires an examination of the P multiple and the PEG ratio, or as Mr. Shah puts it, it's about being ahead of the curve. So this is the broader philosophy. I hope some of you are using it as a part of your own investing. It's a very nice checklist to have. But now let's get on to some specifics. Okay, firstly, and this should not come as a surprise, but this fund house does seem to have a very sweet spot for mid-cap companies. The Motilal Oswal Flexi Cap Fund is a good example of that. Let me go down to asset allocation, and 89% of the holdings of the assets are in equity. But look at this. Of the 89%, 50.7% is actually in mid-cap companies. Now, this is quite rare. Believe me, I've looked at a lot of flexi cap funds, and generally you find about 20, maybe 25% of the assets allocated to mid caps, but in this case, it's 50%. So this is something new. Maybe this is how Motilal Oswal actually prefers to operate. And when Mr. Shah was talking about it, I saw it in a couple of interviews. The reason why he has this soft corner for mid caps is a couple of reasons. Number one, he says that mid caps offer the best growth potential, and there are tons of mid caps which are increasing their earnings by 20-25% every year. And the second thing he points out too is that as compared to small caps, especially, mid caps have a much lower downside risk. A second thing that came out while researching Motilal Oswal, the AMC, is that it tends to focus on high growth themes and certain sectors while avoiding others. For example, one sees a large and mid cap fund, the general impression is that there's going to be a lot of banks, IT companies, energy companies, etc. But when we look here, we see that there is absolutely no banks in this list. There are neither any IT companies and ikka dukka energy companies honge. I was truly surprised to see electrical equipment manufacturers, aerospace and defense companies, retailing, etc., to be a part of this particular fund, a large and mid cap fund. And even when we go down to the flexi cap category, so see here, we have IT software, consumer durables, retailing. So these are all high growth segments. And even within IT software, the focus here is not on your Infosys, TCS, etc., but it's more on companies which are mid-tier. So companies like Persistent Systems, Coforge, etc., which make up this particular sector's constituents. So one way of thinking of it is that Motilal Oswal puts a lot of thought into sector selection and kind of zeroes in on high growth themes which present a long runway in front of it. It's probably the reason why a lot of their holdings are at a P ratio of 50, 60, 70, even 100. But yes, there is no denying that the growth element is strong in most of these companies, which kind of augurs well with Motilal Oswal's philosophy. I raise this because the other two AMCs that we had discussed, which is PPFAS and Nippon India, they generally keep away from such high-priced companies, while Motilal Oswal does not shy away from it. Okay, before I close Motilal Oswal, just one more point, something that equity investors can definitely use is the discipline of rectifying mistakes. What I mean by this is the AMC employs a risk mitigation process wherein if a stock underperforms the index by 15% or more, it gets immediately placed on a freeze list prohibiting any further purchases in the stock. So instead of saying, oh, the stock price has fallen, so let's put in more money behind it, this AMC prefers not to carry the burden of underperformance and instead prefers to deploy any additional fresh capital into high performing stocks. I know it requires a lot of discipline to do this, but Motilal Oswal AMC seems to be doing that pretty well. All right, so these were some observations and specifics that I wanted to discuss in this video. We often hear of things like trailing returns, rolling returns, alpha, beta, volatility, standard deviation, Sortino ratio, downside protection, etc. But something that we don't hear much of is that what is this AMC really good at? For instance, with Nippon India and Mr. Bhan, I found them to be excellent proponents of the GARP strategy. And if that's something you are interested in, or if you don't have it as a part of your mutual fund portfolio, then you can definitely examine it and maybe even consider it. Likewise, with PPFAS, I see a steady hand. Mr. Thakkar, who is very clear on the kind of businesses they want to invest in, which is generally large sized, excellent ROC, low earnings multiple, etc. Additionally, one of their stated objectives is downside protection, which they do by regulating the cash component within their fund. And thirdly, we examined Motilal Oswal's approach to fund management. It seems to have a slight preference for mid caps. There's an aggressive focus on picking companies with strong earnings growth, 20-25%. And although they follow QGLP, the price here, or rather the valuation here, is not exactly how we came through in the previous two AMCs. You can use all this information in the way you want in case you want to start a portfolio, rebalance it, review it, you want to do a new SIP. So all this information can come extremely handy. I do acknowledge that these are only three AMCs that I could cover in this particular video. In fact, some of the most notable misses would include Mr. Shankar from ICICI Prudential, Invesco's Tahir Bacha, Manish Gunwani, he was earlier with Nippon India and is now with Bandhan MF. Chirag Setalwad, he takes care of the mid cap and also the small cap fund at HDFC. Then there's Dinesh Balachandran, who manages SBI Contra. Sandeep Tandon, of course, of Quant AMC, and many other talented fund managers who continue to research, analyze, and aim to continually improve their skill to serve investors like you and me. I'd like to end this video with a quick overview of how you can do the exercise that I did by yourself for any of the fund managers that interest you. Okay, let's pick one from the list. How about Manish Gunwani? I don't have much idea about him. My apologies in case he's watching this video. But let's see how I'll go about this. Okay, first up is YouTube. Let me type in Manish Gunwani. And like clockwork, I'm going to find a lot of podcasts here. So this one's by ET Money, then Money Honey Financial Services. There's another one by Kotak Cherry. I can see about 5, 6, 7 different podcasts are there. So that's good. Let's just pick a couple of them as an example. So I'm just picking the first two. And the next step is to access NotebookLM.Google. So you click on create new notebook and immediately you'll be asked for certain sources. So what are these sources? So we've already found a couple of them, a couple of podcasts that we had extracted.
Small
so
cap investing is not very different from private equity investing.
URL, it's as simple as that. Click on YouTube here.
So Chief, I
Paste
think
it.
covered
Okay,
many
it's
things
kind
and
of
I have
reading
listed down,
this
but I
particular
think
file.
there are 3,
In
4
the
items
meantime,
which are
click on add
already
sources
there,
again, click on
which
YouTube,
your
pick out
crypto
the
versus
second file.
AI.
This was the other one.
Yeah, as well.
Let's paste it here. Yeah, so now we have a couple of sources and we can keep on adding the sources. So let's say I want to find something on something more textual. So let's say Manish Gunwani, and we have about Mr. Gunwani, something on LinkedIn, top 10 equity fund managers. All this might not be that relevant. Um, the Indian small cap space is the best to be in. So there's an article by Value Research. Maybe that works out better. Uh, you can go on to the news. So see, you've got some interviews which are there, right? So this one's by, again, Mr. Gunwani. Structural themes. Just make sure that, when you take in these articles, etc., don't go for a very old one, because he might have said something in 2024, but that might not be very applicable right now. Anyway, let me just pull these 3 articles and let's add it to sources. So what you do is, now within links, just click on website, paste it. Let's take the other 2, paste it back. Last one is this. Yeah, and I think we have these 5 sources, which is a good place to start. If you want NotebookLM to fetch some sources for you, so I think this is a slightly new functionality. So this box here. So all you have to do is type in something like investment philosophy and stock picking strategies used by Manish Gunwani. Yeah, let's do fast research and we click on this. They'll take some time. It'll take about 2-3 minutes to find certain websites. Once all this is done, click on this thing called mind map here. So I'm clicking on it and this will generate a mind map. Right now it's using about 5 sources. So this thing's ready. So let's click on it and see this. So the mind map tool is giving us, on the basis of those 5 sources, it's dividing it, the entire content, into 6 different parts, out of which I think things like small cap investing philosophy, his stock selection framework, what's his risk mitigation strategy, all these things become extremely important. So let me tap on one of these. So small cap investing philosophy. Okay, so what you see here is a nice summary. I use the word summary, although it's pretty comprehensive, but you get to know the small cap investing philosophy, focus on absolute returns and growth potential, and you can read inside it long term horizon, risk acceptance, research and wide coverage, etc. So I'm not going to read inside it, but you can clearly understand things here. There's a lot of reading there, but it's fun, because now you don't have to listen to 2.5 hours of podcasts or go through 10 different articles or PDFs, etc. AI is an excellent research assistant if you use it in the right way. And I think if you just spend maybe a day, you would be able to get a clear understanding of each and every mutual fund that you have in your portfolio, and it really help you give you a better understanding of whether you are on the right path, whether the construct of your portfolio is exactly the way you want it, and whether it ascribes to certain themes which you hold dear, and you really want to construct your portfolio on that basis. So yeah, so I think I'll close at this. My apologies for the length of this video. This turned out to be pretty long, but I hope you have some learnings out of it, and you'll be able to employ these uh, immediately in terms of improving your investing decisions and improving your mutual fund portfolio. So I'll be back very soon in the next 4-5 days probably with another video. Yeah, have a pleasant day, and I wish you the very best. Bye bye.